Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Nextpower Inc. quarterly report. Nextpower Inc., a leading provider of solar tracker technologies, offers a range of innovative solutions for the utility-scale and distributed generation solar markets. At its core, the company provides tracking solutions that cater to various terrain types, including sloped and uneven land. Its flagship product, NX Horizon, is a versatile solution that can be adapted to different site conditions. In addition to tracking solutions, Nextpower Inc. also offers advanced energy management systems, such as True Capture, which helps mitigate power production shortfalls. The company's portfolio of products also includes the NX Anchor Foundation System, designed for challenging soil conditions, and the NX Truss Driver, an installation equipment that streamlines project development. The company's services extend beyond product offerings to include monitoring, controlling, and protecting solar projects through its NX Navigator platform. This comprehensive suite of solutions enables engineering, procurement, and construction firms, as well as solar project developers and owners, to optimize their operations and maximize energy yields. Overall, Nextpower Inc.'s diverse range of products and services has established it as a trusted partner in the solar industry, providing innovative solutions that cater to the evolving needs of utility-scale and distributed generation solar applications. The stock price of Nextpower Inc. has skyrocketed in the past year due to a combination of strong financial results, strategic expansion, and positive news events. One key factor was the company's robust fiscal third-quarter results for 2026, which exceeded analyst expectations and led to an increase in its full-year revenue outlook. Nextpower's decision to rebrand from Nextracker Inc. in November 2025 marked a significant shift towards becoming a broader energy technology platform. This move included expanding product offerings, entering new segments like power conversion, and forming strategic partnerships such as the joint venture Nextpower Arabia. The company's impressive Q2 bookings and strong demand in both domestic and international markets also contributed to the raised analyst price targets. Furthermore, Nextpower's record backlog of over $5 billion indicates significant future business, while its acquisition of Origami Solar and launch of new products like NX PowerMerge have further expanded its technology platform. The company's investment-grade credit rating from Fitch and share repurchase program demonstrate confidence in its financial strength and cash flow generation. Overall, Nextpower Inc.'s stock price has surged due to a combination of strong financial performance, strategic expansion, and positive news events that have boosted investor confidence in the company's growth prospects. Nextpower Inc. market capitalization of $18 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Nextpower Inc. holds a significant advantage in their industry. Nextpower Inc. trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 8.18 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 49% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the solar industry can be broadly categorized into 6 key areas. Government policies and regulations play a significant role, as changes to tax credits, incentives, and laws can either boost or hinder revenue growth. Competition and market trends are also crucial factors, with advancements in new technologies and alternative energy sources forcing companies to adapt quickly to stay ahead of the competition. The development of new solar panels, storage systems, and other innovative products can significantly impact revenue growth. Intellectual property and litigation risks can also have a major impact on revenue growth, as companies must protect their intellectual property rights and navigate potential infringement claims and costly lawsuits. Financial and operational risks, such as indebtedness and compliance with restrictive covenants, can also lead to revenue decline if not managed effectively. Market and economic factors, including fluctuations in foreign currency, exchange rates, inflation, interest rates, tariffs, and changes in government incentives, can also significantly impact revenue growth or decline. Finally, industry developments and trends, such as technological advancements and shifts in customer preferences, can drive revenue growth or decline depending on a company's ability to adapt and innovate. In summary, the solar industry is subject to numerous drivers of revenue growth or decline, requiring companies to be agile and responsive to changes in government policies, market trends, intellectual property risks, financial and operational risks, market and economic factors, and industry developments. Net income experienced a significant increase between 2024 and 2025, with varying percentages reported across different periods. The net income rose by plus 12%, plus 21%, plus 10.2%, and plus 20.1% in the respective time frames. This growth can be attributed to several factors. However, profit margins showed a decline across various categories. Gross profit margin decreased from 34% in 2024 to 32% in 2025, while operating income margin remained relatively stable at 22%. Adjusted gross margin and adjusted net income margin also declined by 2.3% and 1.9%, respectively. The reasons behind these changes are multifaceted. Increased costs from tariffs, potential disruptions in supply chain and transportation channels, decreased demand due to higher steel prices, and higher production costs contributed to the decline in profit margins. Additionally, reduced sales volume and lower sale prices due to decreased demand, increased warranty reserve, production and logistics costs, and delays further exacerbated the situation. The company is generating positive operating cash flow, as evident from the net cash provided by operating activities. In both 2024 and 2025, the company has shown a significant increase in its ability to generate cash from its core operations. The numbers indicate that the company's financial health is improving, with an increase of $27 million in 2025 compared to the previous year. The consistency in generating positive operating cash flow over 2 consecutive years suggests that the company's business model is stable and profitable. This is a positive sign for investors and stakeholders, as it indicates that the company has a strong foundation to sustain its growth and operations. The company's debt level has seen a significant increase of $84,810 between March 31, 2025 and December 31, 2025. However, the interest expenses have undergone a notable decrease. Specifically, there was a substantial drop in interest expense by $3.5 million, or 91%, to $0.3 million. Additionally, another significant reduction of $8.5 million, or 79%, to $2.3 million was observed. These changes indicate that while the company's debt level has increased, its interest expenses have decreased significantly over this period. The performance of various segments and regions has been mixed, with some areas excelling while others struggle. In the realm of poor performance, tracker technology has been a notable underperformer, as have international markets, which face stiff competition from lower-cost providers. Large-scale projects have also experienced difficulties due to delays and rescheduling issues. On the other hand, conventional energy sources have generally outperformed solar energy sources in terms of resources and competitiveness. International markets have also performed well, thanks to a successful expansion strategy. However, there are still areas of uncertainty and potential risk, particularly in new geographic markets, where regulatory requirements and local laws can create challenges. New renewable generation projects face the added complexity of FERC's PURPA reforms, which may reduce opportunities and demand. Additionally, renewable energy qualifying facilities may see reduced prices for output, further complicating their prospects. Despite these challenges, some segments are poised to continue performing well, making it essential to closely monitor market trends and adapt strategies accordingly. Management's outlook for the company is optimistic, driven by several key strategies. One of the main drivers of growth is the adoption of new accounting standards, which will have an immaterial impact on the company's consolidated financial statements. The revenue mix is predominantly comprised of solar tracker system sales, with recognition of revenue from new products, such as True Capture and EBOS in Q2 and Q3 of FY 2026. To support planned growth, the company expects to scale its sales headcount and drive cost-effective manufacturing processes with suppliers. Management also plans to focus on improving existing products and developing new ones, such as energy yield management systems. The company has adequate liquidity for ongoing operations, planned capital expenditures, and other investments for at least the next 12 months. In terms of growth strategy, the company will continue to expand its business significantly within existing and new markets, requiring investments in employee base, IT, and relationships with customers and suppliers. Management is also aware of potential risks such as government incentives, supply chain management, compliance with regulations, renewable energy policies, intellectual property rights, and stock price volatility. Overall, the company's outlook is driven by its ability to adapt to changing market conditions, invest in new products and technologies, and scale its operations to support growth. Management's focus on cost management, revenue growth, and strategic relationships will be key to achieving its goals. The company has made several strategic moves through acquisitions and divestitures to expand its business and optimize operations. In terms of acquisitions, the company has purchased 5 key businesses: Ajo SBI's Foundations Business, Bentech, On-Site, and Origami. These acquisitions are likely aimed at enhancing the company's product offerings, expanding its market reach, or improving operational efficiency. On the other hand, the company has also engaged in divestitures to streamline its operations and focus on core businesses. One notable example is the spin transactions, although further details about this move are not provided. The company's financial policies have been scrutinized in recent reports. One notable aspect of their strategy is the decision to forego dividend payments. This means that shareholders do not receive a portion of the company's profits in the form of dividends. In terms of share repurchases, there is currently no information available on whether the company has engaged in this practice. As a result, it appears that the company is prioritizing other uses of its funds rather than returning value to shareholders through dividend payments or share buybacks. Concerns about inventory buildup and supply chain disruption are prevalent in various industries. A review of several pages reveals that both issues are potential risks that companies face. Inventory buildup can occur when there is an overstocking of goods, leading to wasted resources and reduced efficiency. On the other hand, supply chain disruptions refer to any interruption or breakdown in the flow of goods from suppliers to manufacturers to customers. Multiple pages highlight concerns about inventory buildup and supply chain disruption. For instance, page 40 mentions both issues as potential risks, while page 45 notes that there are concerns about inventory buildup and supply chain disruption. Furthermore, pages 47-54 discuss various factors that can lead to supply chain disruptions, including foreign entity restrictions, tariffs, trade disputes, supplier problems, global economic conditions, steel prices, and natural disasters. The prevalence of these concerns suggests that companies need to be proactive in managing their inventory levels and supply chains to mitigate potential risks. This may involve diversifying suppliers, investing in logistics and transportation infrastructure, and developing contingency plans for unexpected events. By taking a proactive approach, companies can minimize the impact of inventory buildup and supply chain disruptions on their operations and bottom line. That concludes the financial summary for Nextpower Inc. Feel free to comment below, and I will be happy to answer them when possible.